Welcome and thank you for joining today's Succession webinar hosted by ATB. My name is Alan Leung and I'm a Senior Manager of Wealth Products for ATB Wealth, and I will be facilitating today's session. Today's webinar is on tax considerations when selling your business and will be presented by Michelle Seymour, Director of Tax and Business Succession Planning. Now, we all know that no one likes their profits, likes to lose all of their profits to taxes, and being aware of tax considerations when you sell your business will help minimize that. At the end of the webinar, you'll be able to understand the difference between a share and an asset sale, and understand the 3 tests that must be met in order to qualify for a lifetime capital gains exemption, and consider tax planning alternatives to transfer the business to the next generation. Before we start, here's a little bit about Michelle. Michelle is focused on providing ATB clients with complex needs with guidance and information on tax and business succession planning. Michelle is a chartered professional accountant, so a CPA and a CA, and received her Master's of Professional Accounting and Bachelor's of Commerce degree from the University of Saskatchewan. Before joining ATB in 2016, Michelle was a senior manager at Deloitte providing tax planning and compliance services to Albertans and their private companies. During the presentation, if you have questions, please submit them to the chat box. There will also be a formal opportunity to answer questions at the end of the presentation. This webinar will be recorded, and instructions on how to access the recording will be provided to all participants upon completion of the session. As this presentation is open to the public, may I ask any ATB team members who has joined that if they have questions that's internal in nature, please contact me directly with those. I am pleased to pass it over to Michelle, who will now begin the presentation.
Thanks, Alan. And thank you to everyone for joining our webinar. So taxes can have a significant impact on the net proceeds realized on the sale of a business. The purpose of this presentation is to highlight some of the key tax considerations that may be relevant for business owners considering a future sale. So throughout the presentation, we're going to have a few polling questions to the audience, and we're going to kick off the presentation with our first polling question now.
If you are planning to sell your business in the next 5 years, have you discussed these plans with your tax advisor? Please answer the poll now. You'll have about 20 seconds to put your answer in.
Okay, so really the
Oh, sorry. Let's try that again. We lost audio there for a second.
Okay, so yeah, just following up on that first polling question, the purpose of this question is really just to highlight that we hope this presentation provides you with some useful information and food for thought, but ultimately our goal is to encourage you to have further conversations with your tax advisor regarding your tax planning in the context of your specific business succession plans. And so on that note, we're just going to hop over to our agenda, which really Alan has already highlighted what we're going to be speaking about today, but this just lists that out for us again, the 4 topics that we'll be covering in today's presentation. So on that note, we're going to move right over to the first topic, which is a share versus asset sale. So really this is relevant for business owners that are going to be selling an incorporated business. So if your business is structured in a different manner, for example, as a sole proprietorship or a joint venture, this won't really be a consideration, as you'd simply be selling the assets of your business. But in the case where your business is incorporated, you have two alternatives in selling your business: the option of selling the shares of the business itself or selling the underlying assets. So when we look at the two columns, there's a compare and contrast of the two different types of transactions. So with regards to a share sale, this will generally be more advantageous for the vendor or the exiting business owner. In this scenario, the taxes that will be paid would be capital gains taxes on the sale of the shares. And so that would be the difference between the fair market value and the cost of those shares. This share sale may provide the potential opportunity to utilize the lifetime capital gains exemption, which we'll discuss later in the presentation. A share sale may also allow an individual shareholder to utilize unused capital losses from a past transaction. So when we look at the other column, we have the asset sale. And in an asset sale, there'll be two potential levels of tax for the exiting individual. The corporate tax on the sale of the assets themselves, and the personal tax that may occur when funds are withdrawn from the company. The business owner will also have an ongoing obligation to file corporate tax returns unless the corporation is wound up. And it's just important to note, sort of a somewhat recent event, is that asset sales have become less attractive to vendors than they were prior to 2017. This is due to changes that were implemented with regards to the sale of goodwill, which can often be one of the most significant assets that's being sold. So now the asset sale, we can see there's a different preference by the purchaser, and that's that they will generally prefer the asset sale. This is because they may benefit from larger tax deductions in future years when the business is acquired in an asset transaction and the assets have appreciated in value. The purchaser may also prefer an asset transaction from a non-tax perspective because existing liabilities of the corporation will remain with the vendor. And so really you can look at this and say, well, there's two competing objectives, and yes, that may be the case, but really the key takeaway to understand is that an offer to purchase an offer of $1 million, as an example number, to purchase the assets of the business are unlikely to represent the same after-tax result as a $1 million offer to purchase the company's shares. So the purchase price is not the only negotiating piece, but also the structure of the transaction, how it's structured in terms of being a share sale or an asset sale. So what we're going to do next is just look at an example, and there's a few examples that we have throughout the presentation. So this is just a fictitious example, and that's of Lawrence and Carolyn Bennett. They've owned and operated a trucking business for 35 years, and a competitor has made an unsolicited offer to purchase the company's assets for $3 million. Now we've outlined there the assets that would be purchased. So in speaking with their tax advisor, it's proposed that a share purchase may be a better alternative for the Bennetts. Under this scenario, the buyer would also acquire the company's liabilities of approximately $1 million, and the Bennetts may each be able to utilize the lifetime capital gains exemption. Of course, the purchase price would need to be negotiated accordingly. So before we go on to the lifetime capital gains exemption, our next topic, which I've already mentioned a couple times, we're just going to have our second polling question.
Do you feel you have a good sense of the approximate value of the assets of your business? Yes, I know the value based on my knowledge of my business. Yes, I know the value based on my recent third-party business value assessment. No, this is something I need to gain a better understanding of. Please input your answers now. You have about 20 seconds.
So in the example on the previous slide, an unsolicited offer was received. In this situation, it's important that the owner know the value of their company. This will also be important as you plan to exit your business, including in the context of tax planning, which we'll see highlighted in the conversation of the lifetime capital gains exemption in a couple slides. So what is the lifetime capital gains exemption that I keep mentioning? Well, the lifetime capital gains exemption is a tax preference that's provided to allow for the disposition of certain assets on a tax-free basis, and so up to a certain limit. So you can see in that left-hand circle, a very specific number is listed there. Well, the lifetime capital gains exemption was set at $800,000 in 2014, and it's been indexed since that time, so that today that number is $866,912. What does that mean in terms of potential tax savings? Well, if you multiply that exemption limit by the top marginal tax rate for capital gains in Alberta of 24%, the lifetime capital gains exemption can provide approximately $200,000 of tax savings per individual. If you think of a scenario like the one we shared with the Bennetts, there are actually two shareholders in that company, and so in that case, there may be the ability to have approximately $1.7 million sheltered under the lifetime capital gains exemption. If you have more family members that are involved in the business, for example, children who are also shareholders, there may be the opportunity for further multiplication. The lifetime capital gains exemption is especially relevant where the purchase price will be very similar to the amount of lifetime capital gains exemption available. So in this presentation, we'll be talking about the lifetime capital gains exemption in the context of qualified small business corporation shares. It's important to note that this is also available for some other types of property, including qualified farm property and qualified fishing property, which we won't be covering in this presentation. So what does it mean for shares of a company to be qualified small business corporation shares? Well, there are three tests that are considered. So the first is the determination time test, which is highlighted on the left-hand side. And so the determination time test really looks at the point in time where the transaction takes place. So at the time the shares are sold, 90% of the fair market value of the assets in the corporation must be used in active business in Canada at the time the shares are sold. So if you have a scenario where a significant portion of the company's assets are located in another jurisdiction, for example, in the United States, you may not be able to utilize the lifetime capital gains exemption. If there are a significant amount of assets that are used outside of the business, that can also create an issue. So that is really looking at simply the point in time that the shares are sold. So in our previous webinar with Alf Saylor on exit strategies, he highlighted that it's often recommended that you begin preparing for an exit of your business 2 to 5 years before you actually anticipate that taking place. And just one of the reasons to consider that is these other two tests for the lifetime capital gains exemption. And that's because both of these tests consider a 24-month period. And why it's important to have conversations with your tax advisor in terms of your business succession plans well in advance of your sale. So when we get to that holding period test, this one really just looks at the time period that the shares have been held, and that is that 24-month period. The final test is the one where we see that potential tax planning may need to take place. And so this is the nature of assets test. So it's quite similar in terms of the wording to the determination time test, but you'll see that the threshold is different. And so that's in terms of during that 24-month period, so each and every day throughout that 24-month period, 50% of the fair market value of the assets in the corporation must have been used in an active business in Canada. So if planning has not been done and that test has not been met, it may be too late. And that's really why this is something that's important to look at in advance. And so what might be done if you look at a company and you say, I'm thinking of selling my business in about 3 years' time, and there's some other assets inside the company that aren't used in the active business. Well, purification strategies may include selling some passive assets, reducing debt, purchasing active assets, but really purification is not just from a tax perspective. There's non-tax benefits as well, as often redundant assets will not be acquired by the purchaser in any case. So in removing those assets from the company, it can prepare the business for sale. So we're going to look at another example And so in this case, we have Eric and Rachel Lee. They've operated a retail business for 25 years and are planning to retire in 30 months. Of course, that time period is a bit cute. We're listing a time period that would give them the opportunity to prepare if they needed to do so. So they plan to sell to a key employee at that time, and then we've outlined the assets that exist in the company today. So when you look at those different assets that are listed, there's only one asset there that is not used in the active business, and that's their corporate investment portfolio. Now, when we look at the pie chart on the right-hand side, that corporate investment portfolio actually only represents 25% of the fair market value of the assets today. So when we think back to that previous slide, that nature of assets test, they are okay at this point in time. The active assets of 75% are well in excess of the 20 or the 50% threshold. And so, you know, if this was to remain, they obviously need to keep track of this over time and make sure that they don't exceed that threshold in the time to come. But today, in terms of if the plan is to utilize the lifetime capital gains exemption and sell shares of the business, it looks like at this time they're in good shape for that. So prior to the transaction, obviously they'll have to look at that corporate investment portfolio because it's unlikely that their employee would be purchasing that. Okay. So we're going to move on to something of a potpourri of other tax considerations. The first part was fairly focused, but we have just a few other points that are important to think about when selling your business. So from a tax perspective. So the first is something called the alternative minimum tax. And this really ties into our previous conversation of the lifetime capital gains exemption. So alternative minimum tax, or AMT, really is as its name describes. It's an alternate way of calculating taxes, different than the regular tax calculation. In fact, this calculation happens each and every year, but it happens behind the scenes and generally doesn't come into play in most scenarios. One scenario where it may apply is where someone utilizes the lifetime capital gains exemption. So although we've discussed that the lifetime capital gains exemption allows for the realization of tax-free capital gains, the AMT can come into play. So in order to avoid surprises in terms of cash flow, it's important to be aware if there is going to be an AMT. So AMT is not a permanent tax. If AMT applies, it can be utilized to reduce taxes in the 7 subsequent years. And so it really is a cash flow planning perspective. No one wants to find out in April when they go to file their personal tax return that they have a $40,000 tax bill they weren't anticipating. And so knowing that up front and recognizing that, yes, you may recoup those funds over time, just important to be aware so that there aren't any nasty surprises. So the second tax consideration that I've flagged here is something called the capital gains reserve. So the capital gains reserve is something that allows for the matching of the timing of payment of taxes to the receipt of proceeds. So this is really relevant for vendors who may consider providing some vendor financing. So this is a scenario where the proceeds may be received over an extended time period beyond the current tax year, or potentially where there's some significant holdbacks that will apply. So without the capital gains reserve, you would have realized a capital gain, you'd have taxes to pay, and you may not have actually received the full funds from the sale of your business. So the capital gains reserve looks to help match timing. That being said, there are some restrictions, and generally at least 20% of the capital gain must be reported in the year of sale and each of the 4 subsequent years. So if you had your purchase price being payable equally over a 5-year period, the capital gains reserve may help nicely with matching. If there's going to be payments, significant payments in future years or beyond a 10-year period, there may still be some mismatch, but it's something that can be utilized to help with that. So the final tax consideration that I've highlighted on this slide is the purchase price allocation. So we spoke a lot about the different biases of vendors and purchasers when we talked about share versus asset sales. In a similar way, those biases come into play with the purchase price allocation. So this is relevant where you'll be selling the assets of your business. And so in this case, the total purchase price needs to be allocated between the various assets that are being sold. Buyers will generally prefer to allocate a higher percentage of value to inventory and depreciable assets, whereas the vendor will prefer to allocate value to non-depreciable assets such as land. So again, just a piece to realize that that's something that needs to be negotiated throughout that conversation. So there's one final tax consideration that isn't highlighted on the slide, but that I did just want to speak to quickly. The focus of the presentation really is on income tax considerations. But in an asset sale, it will also be important to ensure that GST has been addressed. In many situations, it may be possible for an asset sale to be GST exempt. This may require, however, that certain conditions are met and elections are filed. So it's important not to forget about GST.
So before we move to the next section, maybe give Michelle an opportunity to have a drink of water if she needs it. But to remind everybody that if you have any questions, to please input them into the chat box, and we'll get to it at the end of the presentation.
Okay, so as promised, we're going to speak specifically to scenarios where your intention is to transfer the business to the next generation. So again, in that previous webinar that I've mentioned, Al referenced a survey of Canadian small business owners where 25% of respondents indicated that they plan to sell their business to family members. So what we want to do here is just speak to some specific tax considerations where that is being contemplated. So the first is the idea of an estate freeze. So an estate freeze is a scenario where the existing shareholder or shareholders of the company, so let's say mom and dad, will freeze the value of their ownership in the company. So let's say, for example, they own shares today that are worth $5 million. They'll exchange those common shares that they own today and take back preferred shares that have a fixed value of that same $5 million. Now the next generation can purchase the new common shares at a nominal value, and the future growth, so anything above that $5 million, would accrue to the new shareholder. So in an estate freeze, the existing shareholders will often wish to maintain control of the corporation, and it's possible to transfer future growth to a new shareholder without relinquishing voting control. So where might an estate freeze be useful? Well, it might be useful where the future generation does not have the ability to purchase the company outright, and perhaps it's not their parents' intention that they do so. It may also be appropriate where the future growth in the value of the business will be, at least in part, due to the efforts of that next generation that's working in the business. So there's certainly some alternatives in the estate freeze. You may contemplate a partial estate freeze where the existing generation still participates in some percentage of the growth and along with the next generation. Another contemplation is something called a wasting freeze, and that's where those preferred shares get redeemed over time to provide cash flow to the exiting shareholders. So our next slide here is a bit of a revisit on a topic that we've already spoken to. And so this is an alternative where the family member may be purchasing the company, but they may be purchasing it over time. And so I'd mentioned before that capital gains reserve and how this allows for a 5-year time period. In the specific case of qualified small business corporation shares that are transferred to a child or grandchild, that period is extended to 10 years rather than 5. When we take these two pieces, transferring the business to the next generation, as well as the lifetime capital gains exemption, a topic we've spoken to, it's just important to highlight that if you intend to sell the shares of your business to a family member, you need to be aware of some tax traps that exist that could prevent you from utilizing your lifetime capital gains exemption. And this is something that's important to discuss with your tax advisor if your plan is to transfer your shares to your child. So we have one final example here, and that is of Greg Watson. So he's the sole shareholder of a catering business he began 15 years ago. He's divorced and has 2 adult children, and his daughter Elise has worked in the business for the past 10 years. It's the intention of both father and daughter for Elise to take over the business when Greg retires next year. So in light of that, they've had a recent valuation performed of the company, and it's estimated that the shares are worth between $1.4 and $1.6 million. So Elise has some funds set aside because they've known this is the plan for a while, but they're small in comparison to the total share value. So her dad proposes to provide some vendor financing for half the purchase price, which will be payable over 10 years if she can obtain bank financing for the balance. So obviously something here is just looking at that, the potential for the father to use the capital gains reserve as he's providing this vendor financing to his daughter. So right now we're just going to jump to our final polling question before we go to questions from the audience. And this is really more just for our reference.
So for our reference, what topic did you find most useful in this presentation? Share versus asset sale, lifetime capital gains exemption, alternative minimum tax, capital gains reserve, purchase price allocation, estate freeze. And this is a multiple selection, so you can choose more than one answer. We'll give you about 20 seconds to fill this out. Thank you. Okay, so the Q&A period is now open. There's a question here to give some examples that highlight the concepts of the different sales scenarios. So perhaps maybe Michelle, you can speak to some of those.
Yeah, so I think this really comes down to and why we highlight speaking to your tax advisor, because every sale is very unique. But I think it's important to highlight, we've talked about some rules of thumb. For example, that a share sale is preferable to the person selling the business, that an asset sale is preferable to a person buying a business. Now, those are rules of thumb. And so it's not to say, like I'd highlighted in that, initial slide, it's not that someone at the right purchase price is not going to sell their share or their assets of their business. So I think you really have to look on a case-specific scenario, but hopefully we've highlighted some of the considerations to keep in mind. But we don't really have a case study necessarily in the presentation that was compare and contrast, aside from highlighting, oh, here's what the tax advisor might propose as an alternative. So
just because of the nature of each business can be very personal or personalized and specific to that individual business. So
and things like the lifetime capital gains exemption, for example, they may be very relevant if you're selling your business, for example, for $2 million and you have two individuals, so that means 1.7 of $2 million applies. Yeah. You may really want to look at, is there planning available so you can take advantage of that. If you have an example, a business that you're selling for $40 million, the lifetime capital gains exemption, it's still nice to save the dollars, but it may not be that relevant. If someone offers you that kind of price for an asset transaction, you're probably not going to walk away and say, sorry, I can't sell you the assets because of the lifetime capital gains exemption not being utilized in this structure, right? So that's where I say it really depends on the specific case scenarios, which of these really are the most important, and there may be a number that are.
Another question that's come in is, our operating companies is for sale right now. Like many Alberta businesses, those shares are owned by a numbered company. How does the capital gains exemption work in this case?
Yeah, so in this scenario, it's important to recognize that the lifetime capital gains exemption is available to individuals, not to corporations. So if a transaction is structured where the holding company sells the shares of the operating company, the lifetime capital gains exemption would not be available because the entity selling is a corporation. If instead it was structured such that the shares of the holding company were sold and the shares of the holding company are qualified small business corporation shares, that may be an alternative. There may be a scenario where the individual actually owns some portion of the operating company shares in addition to the holding company. So you really have to look at the structure. You have to look at that 2-year time period. But yeah, very important to note that if the holding company is the only shareholder and those shares are sold, the lifetime capital gains exemption would not be available.
Okay. It doesn't look like, oh, there's one more. Do you know what percentage of business purchases are asset versus share purchases?
I don't have a percentage for you, but I think there is one interesting to highlight, and that's that I think we probably have seen a lot of asset transactions historically. And that's because, you know, there used to be, as I highlighted, there was that change in the rules in 2017 that really looks at the sale of goodwill and makes that less desirable to the business owner that's selling. So I think we may see a shift. If I knew that percentage, I would anticipate that we may see a bigger push going forward for share transactions by exiting business owners than we did historically. I think there are certain industries certainly that are more inclined to asset sales regardless, just because of the liabilities the purchaser may not want to take on. And
are you able to give an example of what industries those might be?
I'm not sure that it would be a specific industry, but just something with significant liability risk,
okay.
Right? So I think you may see a scenario where historically, like I said, there have been more asset transactions, but the world has changed in the last couple of years in terms of the tax rules. So.
Okay. Okay. There doesn't look like there's any questions left. So I guess we'll conclude the call. So thank you, Michelle, for taking the time to walk us through this presentation and a complex and sometimes convoluted topic of tax. There's been some questions which you've answered. So thank you very much. So at this time, thank you all for taking the time to join us today. If you've missed any of the content discussed today, you will receive an email with the recording. So on behalf of ATB, thank you once again for joining us, and we look forward to hearing from you. This is the end of the webinar. Thank you and have a wonderful afternoon.